Hi everyone, this is Tim Melvin of the Tim Melvin Deep Value Report and the Banking on Profits newsletter. I told you we would make the weekend. The kids were in all weekend. It was a little bit crazy until they finally flew out. Didn't get anywhere near as much done yesterday as I expected to. Just too nice a day. Spent a lot of day out in Lanai watching some baseball on my phone. I've got that MLB package so I can stay in touch with my Orioles and reading a couple of books. So never got to it. So once again, the weekend video becomes the Tuesday video, but it's not like our world moves so fast that that's going to hamper us in any way, shape, or form. Anyway, over the last week, the Dow Jones Industrial Average up about 0.25%, nothing big coming into today. The all-world URTH was up about 25 basis points, and of course both of those got slapped around pretty good during the day today, and we'll touch on that here more in just a second. And in the small bank index, the QABA was up about 1.62%, and interestingly, when I checked my portfolio of small banks at the end of the day, we actually ground out about a 10 basis point increase in those things. Now, I beat the drum on those time and time again. You guys know the story. You should be signing up over at marketfi.com for Banking on Profits and kind of join us on this ride that we think is going to have spectacular profits over the next 5 to 10 years. And really about the worst outcome I see, barring the end of the world, is that we beat the market and we do okay. I actually think it's going to be a lot better than that over time, and you really need to be in this trade of the decade in the small banks. But anyway, stepping down off the soapbox. Got slapped around a little bit today. The Dow had a pretty good loss. The S&P was off as well. Lots of different things cited. The Spanish elections, the anti-austerity parties made some pretty strong gains, and the ruling party had the worst polling showing that they've had in quite some time. And that probably ties a little bit back into Greece, because it does look like Greece, may default. They're going to have a really hard time coming up with the IMF payment in a couple weeks, and it doesn't look like they're going to be able to just use the IMF's money to pay them back this time. Although maybe they'll find a way. Who knows? It's insane over there. I still have a high degree of confidence in the long-term future of our Greek banks. I don't check the price day to day. They're up and down 20, 25% a day is not unusual for our Greek bank holdings. They are a small percentage of the portfolio. From 100% wrong, they're not going to hurt very much at all. If I turn out to be 100% right, they're going to make us an enormous amount of money over, say, the next 7 to 10 years. That was my time frame when I bought the thing. So still like them. Just, watching them day to day could absolutely make you insane. Same goes for the stock market. There's only one thing everybody's watching, guys, and that's the central banks. If and when are they going to raise interest rates? Now, they're signaling to us that they're going to raise rates in the fall. And every little piece of good news, like the durable goods report that came out today, is being used as an excuse to celebrate the fact that the Fed's going to stay right on track. They're going to raise those rates a little bit. But the stock traders don't really like that. They don't want the punch bowl to be taken away. The jobs report, everybody says it's firming. I've referenced this before. It's not firming. Okay, Louis Navellier pointed out when I talked to him, and I think I've mentioned it before, we have a serious double counting program in the jobs number. When you are working 2 jobs, you count twice. So if you had a job pre-crisis, lost it, got downsized, whatever, and you're now working 2 to make the same income as you were pre-crisis, you count twice. And there's a ton of part-time employment out there. A lot of people are not willing to step up and pay the full cost of benefits, payroll taxes, and all of that nonsense for full-time workers. So we're seeing a lot of part and temp work out there, and they're double and even triple counted in some instances in the jobs report. The jobs report is actually just okay. So anyway, today we're going to talk about something I've been big on research all my life, and I read all of the academic reports that strike me as interesting and worthwhile. If Andrew Lowe writes something, I'm certainly going to pop over and read it. Now, I frequently have to call some of my more higher math inclined friends to walk me through the statistics. There's a couple professors around the country that probably cringe when they see my number on the caller ID, but I do read these things because I want to stay up on what's happening. I want to know as much as I can about making money in the stock market. And of course, as time has gone by, technology has made it easier to read these things, to do the research, to crunch the numbers. And today, I finally find that technology is really starting to catch up with my incredibly limited skill set in database and spreadsheets and programming and all that stuff. A lot of it now I can just almost do by push button, although got some other friends around the country. I'm sure Tobias Carlisle out in California just looks down and goes, "Oh, jeez, not again." Every time he sees my number, he's one of the better guys I know at working with this stuff. So when I get stuck, I call him. And of course, he did all the research for his books, Quantitative Value and Deep Value, himself. So I find him to be a great resource and a decent friend to put up with my nonsense. But anyway, I'm starting to get there. I've been doing a lot of testing and crunching and looking at things. And some of this confirms things that I've pretty much known all along. But it's nice to see the numbers right in front of me. And we're really going to be talking about this theme a lot going forward, because what we found, and this is through hours and hours and hours, got the baseball game on in the background, nice big glass iced tea, and just sitting here and crunching numbers and working on theories and checking it against the academic works and calling around and asking other people for their thoughts. And we've come up with, or I'm going to brag myself a little bit. I've done a lot of work on this, so it was me. The dog cannot type. She's lousy with her keyboard, and her database skills are non-existent. But she's good company, and she does root for the Orioles, so she's usually around when I'm doing this stuff. I found 4 definitive ways to get rich in the stock market. Now, these 4 ways are not for professional investors, okay? If you're a risk arb guy, or you're doing stat arb, or you're an options market maker, or you're doing special situations, you're working 10 to 12 hours a day, you've got to figure it out. You've got your own approach. These don't necessarily apply to the guy who's working on Wall Street day to day or running the big hedge funds. They apply to guys and girls, ladies, that get up every day. They get the kids ready for school. They go off to work. They come home, they get the kids dinner, maybe they got to go to a basketball game or a baseball game. They own businesses, they own print shops, tire shops, they're lawyers, real estate brokers, insurance agents that work really hard at their profession. They make a good living, then they turn around to Wall Street and get absolutely taken advantage of as they try to grow their nest egg. So we found 4 things. These can all be done in a few hours a week, a little bit after work in the evening. Maybe a few hours on a Saturday morning. They're very quantitative. We're not going to take you into any deep analysis. One part of it's qualitative, but it's going to be really obvious to you when I tell you what it is. 4 ways to definitively make money in the stock market. Most people who are not like me, I'm a value specialist, and I do this for a living. So I have those 10 to 12 hours. I am in front of the screen. I can do the deep digging that needs to be done to find special, quirky little situations. And so we're willing to do that. But the 4 ways, all quantitative, need a good stock screener, reasonable access to information, and kind of an understanding of markets and general finance. But if you got that, these 4 things are going to work for you. The first one is going to really surprise you coming from me. But the first way to consistently make money in the stock market over time is momentum investing. Now, that's the absolute opposite of what I do, value investing. But Cliff Asness of AQR Management, whom I have a lot of respect for, has done an enormous amount of work on this, as have the folks at LSV Asset Management and a few other research-driven shops around the world. Momentum works. It works extraordinarily well. It can have some, occasional blow-ups. But the truth is, most people don't understand momentum investing. And it's certainly not my forte, but I have found some ways to make this easier for you. I'm going to be doing some series of articles to kind of walk you through how to do some of this. But if you think of momentum investing, what pops right up to the top of your brain right now? Tesla, Apple, Google, Microsoft, all the the big tech stocks, the stuff that's on TV and being talked about every day. But you know what? I ran some of the better momentum screens, one that I built, and then one using a tool developed by Louis Navalier, who's probably the best of all at this game, called Portfolio Grader, that's available over on his site. If you Google Portfolio Grader, the tool will come up. It's free to use. It's pretty cool. You put your stocks in it. It gives you a grade from A to F. A's are great. F's are bad. So it's not rocket science. You could literally flip over 100 stocks in less than an hour using this thing. It's very generous of him to put that out there free for the public use. It's in the public domain. Great tool for the momentum portion of your portfolio. Highly recommend it. I really think that you could do some interesting stuff with the Value Line Top 100 one-rank stocks and Louis Portfolio Grader, but I haven't really tested that idea yet. I will be in a reasonable period of time and writing some articles about it. But those are the names you think of for the big and exciting ones. But I ran a momentum screen, as I said, that I developed and tested, and then I used Louis' screen to check out a whole bunch of stocks. I think I had like 700 stocks that I input into this thing using a couple of filters for earnings and price momentum. And I looked for the great momentum stocks that you should be buying in a momentum portfolio right now. Those big guys aren't in there, fellas. Jones Lang LaSalle, a real estate broker, they're in there, as is Walker & Dunlop, a real estate finance firm. Vail Resorts makes the grade. Home Street, a bank, makes the grade, as does Helen of Troy, and they make small handheld appliances, your hair dryers and stuff, primarily. So these are not what are traditionally thought of as momentum stocks, but they're absolutely the momentum leaders right now. So got to adjust your definition for what momentum is. Lots of good stuff to read out there. But for a really good understanding, Louis Navelier's book, the little book that makes you rich. I had to check the title. It happens to be on my bookcase because I worked on it with Louis, and it was a lot of fun to do because I had to do some wildly outside the box thinking for me at the time. So momentum investing absolutely works. And it complements value, and I'll talk about that here in a little bit later. But some portion of your portfolio should probably be devoted to momentum investing. But just keep in mind, it's not what you think it is. Those stocks that are on TV every day, the Googles, the Amazons, the Teslas, I'm having a hard time bringing up all of them right now, they're still in that center. The profits for you and I as individual investors are going to be out here, whether it's value or momentum, in smaller companies that Wall Street is just now finding out about and starting to pile money into. The money's on the edges. The professionals are on the middle trading back and forth between themselves. We don't want any part of that. But we can develop an approach that even if we're not rocket scientists, we can use what the rocket scientists are using to properly manage a momentum portion of the portfolio. Now, does that mean I'm throwing the towel in on deep value? No, it's what I do. I'm full-time. I'm a specialist, okay? And I've been doing it for years. And I think that a portion of your portfolio should always be devoted to deep value investing for the one simple reason. It works. In most of the tests, it works a little bit better than momentum. But it doesn't correlate with momentum strategies. Now, you can use price to book value, which is my favorite because I'm an older guy and it's what I've used all of my career. And I find large piles of assets and cash very comforting in the companies that I own. Whereas Tobias Carlisle and some other guys, Wesley Gray, Patrick O'Shaughnessy comes to mind, who just wrote that great book from Millennial Investing. If you have a college student, you should have bought it for them by now. They like to use the enterprise value to EBIT, earnings before interest and taxes. I like that one. I use it in conjunction with price to book value, but I vastly prefer book value on its own. Each one of these four ways, by the way, there's going to be some subsets and schools of thought because everybody does, there's different ways of doing momentum. There's different ways of doing deep value. The thing to do is pick the one that fits your personality and style the best and run with that one in conjunction with the other strategies. Deep value works, net stocks, buying companies below liquidating value, deep discounts to the underlying asset value, net cash stocks, negative enterprise value stocks. All portfolios of these things just absolutely trounce the market. Now here's the thing. The returns here are very, very lumpy. In times like today, when the market's been going up, we're going to lag using a pure value approach. Okay, there's not a lot of opportunities around. There's not enough stuff to buy. You can't get fully invested. The market's been running up for 6 years in a row, so you can't find anything that really is safe and cheap, passes a credit test, could be considered a quality stock, for example, using the Novi Marks model. So it's hard to get your money to work. You're going to lag as the bull market ages. However, when the market rolls over and starts to go down, your stocks are going to hold up better than the decline in the market. And as you approach a bottom, there's going to be literally hundreds of unbelievably cheap quality companies with safe balance sheets to buy. And from the bottom out for the next 2 to 3 years, your returns are going to be the stuff they write legends about. Okay, they're going to be just enormous. For instance, net stocks after a bear market, once the market bottoms, they usually have a triple-digit year the following year. So deep value returns are very, very lumpy. Okay, so now if we put these with a momentum portfolio, what happens is we start to smooth out the returns a little bit. Momentum does better as the bull market ages because all of the money is starting to chase a narrower pool of stock, and you've got larger amounts of money driving that stock price further and further and further. A little bit of play the pass the burning match. You're going to have longer periods of outperformance during the bull market period than you will with the deep value. Deep value is going to 2 to 3 years spectacular. You start to edge back towards the middle. You perform in line with the market, and then eventually, as the market tops, you underperform the market. Exactly the opposite for momentum investing. So they don't correlate. They both outperform. So when you put them together, you get higher returns with less volatility. Is what Cliff Asness found. I've tested it. It works. So I'll always be a deep value aficionado, guys. It's what I do, okay? But I do think a momentum component, particularly for younger investors, might make an enormous amount of sense. But deep value, it works. You should be using it in your portfolio. Relying on the research of guys like Roger Ibbotson, who said illiquid value stocks clobber large growth stocks over large liquid growth stocks over large periods of time. So deep value belongs in your portfolio. It's one of the 4 ways to get rich in the stock market for just regular folks who are not using algorithmic trading systems that are being managed by guys that are literally rocket scientists out there on Wall Street. So what's the third one? The third one's also one of my favorites. It's just the buy and crash theory, folks. Sit back, build up cash. When the market crashes, be a buyer and just hold on to those stocks until you get towards 5, 6, 7 years out, when the blue chips start to get just ridiculously priced, and you can start to pare some of your holdings. Some people use the buy and crash and never sell the stocks. I use it, and I inevitably end up selling the stocks a year too soon. So anyway, buying in a crash. It sounds like, oh my God, what am I going to do? Just sit around and wait for a crash? Yeah, with a portion of your portfolio, that's exactly what you should be doing. Somebody asked Charlie Munger at the Daily Journal meeting earlier this year, what's the secret to getting rich? And it was have cash when the opportunities come along. He also said a few years back that this can be quite frustrating to sit there with piles of cash. But he didn't get as rich as he is by buying mediocre opportunities. So you want to sit back with a portion of your cash so you can buy great companies when they're great bargains as well, and then hold on to those until they either become grossly overvalued or the rest of your life, whichever fits your personality better. Once you're fully invested buying in a crash, you immediately go back to trying to rebuild that portion of your portfolio. That I'd keep it at 25%. That's devoted to buying in a crash. You would just start accumulating cash as much as you possibly could, based on your income and expenses. But this has built some of the biggest fortunes in the world. Warren Buffett, post Berkshire Hathaway, once he became Berkshire Hathaway and the assets under management, he was controlling whole companies. He couldn't do net current assets in special situations anymore. They just didn't scale. Once you got up into that billions of dollars mark, you can't do it. They're too small to be significant. He became a crash buyer. Everybody talks about Warren's big position in Coca-Cola. He started buying that in 1988, right after the crash of 1987. In the internet bubble, all of a sudden he went from irrelevant to very relevant because he was making some very smart purchases. And they're going to write books about what he did in 2008 and 2009, where he was buying special preferreds from Goldman Sachs and Bank of America, and he was accumulating these large financial stocks that were in distress and clearly out of favor. Warren bought a lot of stock in 2008, 2009, and that's been a lot of the driver behind Berkshire Hathaway's successful run since that happened. Charlie Munger, he didn't miss either. Over at Daily Journal in 2009, he put all of their cash, so much of their cash, that the SEC called him in and had him defend why he did not need to be treated as a money management company. He ultimately won the day with his argument. I would expect nothing less. But he bought a bunch of shares of 4 or 5 stocks at the bottom in 2009, and as a result, his book value has gone from $19 a Daily Journal share to $97 today, a 31% compounded rate of return. He sat there with that cash generated by all those legal newspapers, and he waited. And when the crash got there and everybody was panicking and the world was ending, he very calmly bought a bunch of stock and got rich. It has worked for Sam Zell in the real estate markets. Hattie Green became the richest woman in the world using the buy and the crash technique. Andy Beal has made a large fortune only buying in distressed situations that have crashed. Power markets in California post Enron, airline bonds after the crash of 87, Texas real estate when oil fell in the 90s. He only buys in a crash. Real busy in 2008, 2009, and made an absolute ton of money. I would say for his investors, but he doesn't have any. He owns the bank, so he made it all for him. So, but he's a billionaire by buying in a crash. And of course, our old friend Mr. Womack, the pig farmer, did very well for himself over the years by only buying in a crash. He never lost money on balance in the stock market during the course of his lifetime. An impressive achievement, to say the least. So, third cornerstone is buy in a crash. Look, the fourth one's not going to shock anybody that knows me. The fourth way to get rich in the stock market is the most boring way to get rich in the stock market, and that's buying small community banks when you can get them at a discount to book value. They have reasonably strong balance sheets and clean loan portfolios, preferably with an activist involved in the stock. And we've referenced the study several times, but Sterne Agee findings were completely in line with mine, both before and since. If you get a small bank at a discount to book value, we'll use 85% as the number that I prefer. I'll go up to 90, but I like 85. That has equity to assets ratio that indicates they've got plenty of capital to pay dividends, buy back stock, run the bank, and deal with any problems that come up. And non-performing assets are a very low percentage of total assets and preferably trending down. You buy that stock when there's an activist, a 5% or more shareholder who is determined to increase shareholder value. You outperform the relative bank indexes, or at least you did in their study, by something like 28% a year. Now, the indexes during the same holding period had a 17% a year return. So you're talking returns north of 40% when you have an activist involved, if you buy right around the time they do and exit the position when they do. And by the way, most of those positions, not most, I'm sorry, but almost a third of the positions were exited by takeover. A lot of others were exited by selling into share buybacks and things of that nature over time. These guys tend to get what they want. The bank shares are too cheap. They own a lot of it. They want the price higher, whether by buybacks, operational improvements, divestitures, or outright sale of the bank. They have a tendency to get their way in the matter. So community banks at a discount to book value with activist involvement is the fourth of our 4 ways to get rich in the stock market. I think that you can pick among the 4. Ideally, if you're not a hands-on investor, I think you should have your money split between the 4 and rebalance every couple of years. I think that would probably work out best for you. But you could just do community banks and the buy in a crash. I think momentum, if you have a momentum strategy as one of your 4, you have to have an offsetting value, non-correlating strategy. So I would either do momentum in community banks or momentum in deep value. If you're fixated on value the way I am, I think you could do the deep value, the buy in a crash, and the community bank. So you can mix and match based on your personality. But I really think this is going to work best if you devote some portion of your portfolio to all 4. Particularly if you're a millennial or whatever we call the generation that came before the millennials. I think that was Generation Y. I can't remember all those silly labels. But if you're in your 20s, 30s, early 40s, you should have a balanced bucket of these 4 strategies. I'm going to do a whole bunch of articles over the next few months to talk about ways in which we might achieve this worthy goal. Those are the 4 ways to get rich. Doesn't take rocket sciences. It's not going to take up a whole lot of your time. If you just subscribe, as a for instance, to the deep value in the community bank stocks, and then held a bucket back to buy stocks in a crash, and use Louis Navalier's free tool, Portfolio Grader, that's on his newsletter website. You just kind of put in Portfolio Grader, the Google or whatever, take you where you need to go, and you can start ranking stocks. We'll talk about how to put those ranking ideas together in the weeks ahead. Anyway, I'm really excited about this research. I've crunched a ton of numbers on it. Unless there's a significant change in the world, these have worked for decades since the anomalies were discovered. Because they're out on the edges of the market for the most part, you have no competition. The institutions aren't interested. These are not large enough companies for them to get tons of money. You can't run billions and billions of dollars and collect those massive fees in the momentum stocks we're going to be talking about, the community banks or most of the deep value stocks, and you just don't get paid on Wall Street for sitting around waiting to buy stocks in a crash. You're not going to be able to charge a 1% incentive fee on cash that's earning 25 basis points. even if you were earning, more normalized 3% interest, folks are still going to be pretty bad about, upset about a third of the return going to pay you 1% management fee. So we're not competing with Wall Street anymore. We're going to use the 4 ways to get rich. We're going to operate out on the edges and margins, do all the things that everybody else doesn't do. And after a while, as John Templeton told us, if you do what everybody else does in the stock market, it's impossible to do better than the stock market. Our aim is to show you some ways to do not just better, but a whole lot better than the stock market, and amass enough wealth that as you get up to retirement, then we can start talking about our other strategy, which of course would be income-based investing. We'll talk about that as we get later in the summer, because I've done quite a bit of work on that in recent months as well. Anyway, going to be talking more, writing articles and doing videos about this stuff over the next several months. But for now, there's a baseball game getting ready to come on, and I think the chicken's getting ready to come off the grill. So I'm going to go eat some dinner, watch a little baseball, and enjoy the rest of the evening. I suggest you do the same. Have a great week, everybody.